Hey there, friends. Welcome to the weekly market update. What are the words of the day, you ask? Debt ceiling, and it's a big, scary thought here. Let's go ahead and get into some slides real quick. Obviously, this is Home Finance with Phil. Thank you for joining. So we're looking at rates, and they are obviously up. They've been up, really creeping up for the past week or two. And we teased with the debt ceiling thing. So these are the rates at investopedia.com. The reason I use these rates are because they're very quick. It's really easy to get a hold of, and also because it's really important to me to show you what the rates are without just trying to sell rates. So these rates are based on no mortgage points. These are the average rates if you came in and didn't spend any extra money to buy down your rate. When you see these crazy low rates, it's because they're charging a lot of points to borrowers. We definitely try not to do that unless a borrower just decides to do that. But that's not something I roll with unless it's a decision kind of made together. Um, Looking at the chart, you can see it's not good, right? Yesterday, towards the end of the day, though, we did hear some news. I guess leading into the day yesterday about I think it's Saudi Arabia decided that they were going to slow down their oil production. That was a negative effect on the market. You can see it here. So between that and the fact that our debt ceiling is not being agreed upon and is coming up due, there's other agencies that monitor crediting that are starting to get kind of look at the U.S. with a side eye, and it's becoming a problem for the mortgage market and for really all bond markets. It's affecting people buying and selling the bonds. So unfortunately, just saying, "Hey, we're going to sign a debt ceiling agreement," isn't necessarily the answer. The answer is to sign one that doesn't laden with a bunch of extra fees. So if they sign an agreement, but it's got a bunch of extra money in there that the Treasury's just going to make more money, that's bad for inflation, and that's not a good thing. So hopefully, here pretty soon we see something happen, and it's something that it's more down the middle, maybe cutting costs a little bit, but still putting us in position to not default on loans. Um, and usually when you see this big of a drag, this big of a move, we're kind of down here at a floor level that is pretty strong. So what happens is if we get any sort of good news, all of a sudden you can see this thing just jump up like crazy. So it might be a wild swing going in the better direction for us, but only time will tell, right? I wanted to just bring up too, I've seen a lot of this. It's just something to look at for our real estate agents. So we're starting to see again where properties are selling above the list price. You can see in the chart over here, obviously back in like February and June of 2022, when we saw that crazy time where everyone was offering, 50,000, 100,000 appraisal waivers, all this stuff over list price. That did fall off as we came along. We've been looking pretty good, but look at the climb. We're starting to climb again. So we're starting to see that sort of market. And I know it's exciting, right? Yeah, it's exciting for all of us to have these conversations with our client and talk about waiving appraisals and whatnot. But we're pretty much there. I also wanted to talk about the fact that you're looking at investors in general, people with money. They're starting to take money out of the bank and they're starting to deposit it in money market funds, which I think is a great thing because I think maybe this indicates that people are being a little smarter with their money. You don't get any money from banks. Banks pretty much take your money. Money markets, though, like Fidelity, I don't know, just anyone else. Fidelity is the one that jumps to my mind. No commercial for Fidelity here, though. But you can put your money in the money market, still have access to it within a day, and you're making maybe 2, 3, 4%, whatever the going rate is at the time, instead of sitting in your bank, where the bank is taking that money from you and putting it into a money market. So you're seeing that maybe people are having a little bit of a swing on how they view that. That's pretty much it today. I want to spend a little bit of time talking about the gas thing and the rates and what we're looking at with the debt ceiling. So hopefully we have something different that just happens soon, and we can kind of move on from there. As always, we are here this weekend. If you need anything, please give me a call. We're like all of you. Our phones are always on, so me and my team will be here if you have any questions or needs. And if not, have a wonderful Memorial Day weekend, and hope to see you soon. Thank you.